Okay, are you guys there? Hello, hello. Ready for some training?
Hello everybody, good morning, good afternoon, good evening, depending on where you live on this planet. So first a sound test. Do you hear me correctly? And do you see my chart? Okay, thank you very much. So before starting the content of this session, which will be an important session too, I would like to first of all to answer some questions some of you have asked in their homework. Incidentally, many homeworks were excellent, and as usual, the grading of these homeworks were also awesome. So thanks to the graders. So some question first of all. One of the questions which is often asked is, can we enter a trade if the Vinini is not completely validating the trade? Let's take an example here. Here you have a possibility to make a remo. Let's mark it an arrow here. Okay. You see it. At that moment, 3 bars later, you have the Mo line which is pointing down. All the indicators, the RSI, the OBOS, the accelerator, the MACD also are positive, favorable, except the Vinini. And normally, the strict rule would say that don't take this trade. However, you see that in this case, you have the green line of the Vinini which is pointing down and which is inside its Bollinger Bands, its volatility bands, and it is quite near the yellow line, its average line. So in this case, when these conditions are filled for the Vinini, you can take the risk to open the trade, but be very cautious, very careful to eventually close your trade if if something goes wrong with this trade. So in this very particular case, you can also open your trade. Okay, it will be a little more risky, but you can take your chance here. Another often question is, do you use the Fibonacci retracement? And the answer is no. It is not necessary with the MAX system to use Fibonacci retracement as any other tools, many tools. And I will show you it is not necessary. Let's take an example here. You have this wave, this nice down movement, and we can ask the question, we can take the high here or there, and the low here, and we can ask the question where this movement can retrace, until where can it retrace. And if we draw the Fibonacci line, the standard Fibonacci line present in all trading platforms, you see that the price retrace here until the 50% line. You don't see exactly the numbers here because they are small, but I can tell you it is the 50% line, and you see the price just retrace back to this level. And what do you see at that level? A tiger tunnel. Isn't strange, this case? You can make this test on as many charts you want. You will quite always see this phenomenon. Whenever you will have a retracement level with the standard Fibonacci retracement or even extension, if the price goes there, it will be most often coincident with a tiger tunnel. A similar problem or similar situation is also if you take all kinds of chart patterns, head and shoulders, inverted head and shoulders, double, triple tops or bottoms, triangles, flags, pennant, which allows to draw a support line or a resistance line or trend lines, uptrend line, downtrend line. You will often see that when the price breaks these support or resistance lines, it is very near the Tiger tunnels. So this means that the Tiger tunnels is in fact a unique and elegant generalization of all these concepts of resistance and support. And so you can forget all your old tools and use only the Tiger tunnels. Okay? So let's take off the Fibonacci retracement. There is also another frequent question about how can we use higher time frame to have a more accurate entry with our trade. I have explained last session that you can use here the signal bars, which show you what the price or what some indicators are doing in higher time frame or smaller time frame. And what is important is not the detail of each time frame, but what qualitatively each time frame is doing. And you have to have a majority of the status rectangles here to have the same color as the time frame you are trading. If here you are on the 5-minute chart in a downtrend, it's better if you have in a 2 or 3 closer time frame a majority of red color. If it is in an uptrend, you will have to have a majority of green color. But it's not necessary to have all the status to have the same color. Okay, and if you think about that, it's largely enough, because you have already on your time frame here, your traded time frame, you have already all the information you need for higher time frame. Think about that. The home base. The home base is a 233 period moving average. 233 is quite 11 times the 21 of the 21 moving average. So this means that the 233 moving average, the home base, represent what the 21 moving average is doing in the 1 hour time frame. Because 11 it's quite 12, and 12 5 minutes, we are in a 5-minute time frame, is 1 hour. So you have here with the home base what the trend, the traded trend in the 1 hour time frame is doing. Okay? Also, if you take the 89 is quite 4 or 5 times the 21. So let's take 5 times, for example. 5 times 5 minutes is 25 minutes. 25 minutes is quite 30 minutes. So the red balance line shows you what the 21 is doing in the 30-minute time frames. So you have here in your traded time frame all the information you need with the moving average and with the signal bar on higher time frame. And you can be sure that if you trade following the trend in your time frame, you will be quite always in sync with higher time frame. Okay? Well, and a very important question has been asked by one of you. It is, what is the importance and the hierarchy of the indicator? Because sometimes it seems that the non-line moving average is more important, or sometimes the Tiger tunnel is more important, or sometimes one of the 3 EMA, and so on. In fact, with the max, we can say that everything is important. Everything in this zone, in this first zone, where the price is evolving. All the other indicators, in reality, are not necessary, but they are there to help you to analyze the situation. But with practice, you will be able to drop some or even all of them. On this screen, the screen where the price is with the EMAs, the Bollinger Bands and the Tiger tunnels, you have the basic of the max. And to analyze precisely, accurately what the price is doing, there are a lot of situations you can analyze. But all these situations respect one general and simple concept. Let's take some example. Take this one here. You have here, let's show this situation with an arrow here, a possibility for a scaling, okay? Because you have the price who cross down and close below the Mo line, so you have a possibility for a scaling. I have put a slanted white line here to show the entry. But what do you see at that place? you see that where you can make your entry, you are below the Mo line, but you are at a few pips. How many? How many pips from a tiger tunnel? You are at 3 pips of the green tiger tunnels. This green tiger tunnels, you know, may act as a support or a resistance. So here you have a critical point for your entry. And 3 pips, it's not much pips, not many pips. You have better to wait for the price to commit itself in the direction of the trend, and it's better to wait the price itself cross the tiger tunnels before entering the trade, before taking the scalings. But in another situation, if you are far enough the tiger tunnels, for example, like here, in this case, you are well far enough the next tiger tunnel, which may be eventually a resistance zone, you can enter the trade when the situations tell you you can scale it. Moreover, you see on the contrary that the price here is just below the previous tiger tunnel, which here serves as a support for the down movement or a resistance for the up movement. So this is a favorable situation. So here you can enter immediately. And so any line on your chart, a moving average, one of the 4 moving average, the tiger tunnels or the non-line moving average can have this role of support and resistance. So whenever you must enter a trade, always ask yourself, will the price eventually meet very soon a resistance? If it is not the case, you can open the trade. If it is the case, wait for the price to commit more itself and to cross that resistance zone. Okay? That was another very important question which is often asked. Well, now let's come to the content of this session today. Let's show the PowerPoint presentation. So, first of all, we will make, as usual, some recaps of what we have seen at the last session. We will see some new points about the OBOS indicator. We will see also some points with the waves and the tiger tunnel, in fact the relations between the tiger tunnels and the waves, in order to introduce the next kind of trades we can make with the max system, which are the primos. And the primos, as you will see, are the counter-trend trades. Not scalp trade, but counter-trend trades. After that, we will complete, of course, the presentation with some more techniques. And for your comfort, we can add some more indicators with funny things like alarm and alert, for example. And we will complete our page of do's and don'ts, and of course the homeworks for the end of this session. So now let's review some points we have seen last session. Many of you have done their scrolling statistical exercise, homework, and you have found approximately the same percentage of winning rates of the Mo for all the kind of Mo, BOMO, BTMO, SafeMo, ReMo. And I think I have already given to you this kind of statistic, how many scales in a Mo may have. And this is an additional information I can give you now. Every day, for each pair, on a 5-minute time frames, you will have approximately 3 moves. So this means that if you follow, for example, if you monitor 4 pairs, you will have more than 10 opportunities each day to open a max trade. That is to say, a Mo trade followed eventually by 1 or 0 or 1 or several scales in. And so this means that you know that every day or quite every day each pair has a good movement up or down. It is so necessary to have patience and disciplines to catch just these 2 or 3 Mo's on that pair that day. And a lot of patience and a lot of disciplines. Okay? Well, what we have also seen last session was the use of the accelerator indicator, which is just a tumbler, an additional tumbler, when the accelerator is favorable for the trade. When the accelerator is favorable for the trade, this means that the movement gains strength in the direction of your trade. I have just spoken a few minutes ago of the signal bar, so it is not necessary to review this concept. And we have seen the big subject of last week, of last session, the tiger tunnels. And we have seen that the tiger tunnels defines successive consolidation zones, support and resistance. The price may cross this zone and achieve the next level, or it can bounce off from that zone and goes back to the previous level. And these tiger tunnels may be used to bank profits, to close some units in order to reduce your risk for your remaining open trades. And we will see later that they can also be used for scalings, for additional scalings. Whenever the price crosses one tiger tunnels, in some circumstances you can make an additional scaling. And I have also explained that you have to pay attention to the middle level of two tiger tunnels. This will be the case especially when you have two pairs which are well correlated. Take two pairs, whatever you want. For example, the euro yen and the GBP yen, they are positively correlated and well correlated. You will often see that when a pair bounce off at the middle level between two tiger tunnels, this is because on the other pair, the bounce off is precisely on one tiger tunnel. And so in this manner, you can also profit from the correlation of these two pairs. Just observe the chart and you will see this phenomenon very, very often. And then we have also seen how the tiger tunnel may be used for exit techniques on the tiger tunnel rejection, and of course when the price bounce off the middle level between two tiger tunnels. Okay? Well, now let's go to the chart. Today we are going to just modify somewhat these templates. This was the template of last week. And what we are going to do is we are going to move the STO RSI in the zone here of the MACD, and we are going to add another obus. The yellow obus here is the obus with a parameter of 13. 13. Yes, 13. We are going to add another obus with a parameter of 5 period. And this obus will be very important. These two obus, in fact, will be very important for the primos we are going to see. So to do that modification, I have already prepared a template, of course. This is the template. No, this is not this one. It is the 5A. Okay. Now you see here in the zone of the STO RSI, of the MACD, the STO RSI in magenta. And now you see the green line here, which is an obus with 5 periods. Okay. And what will be important in these two obus, what will be important are the situations when the two obus show simultaneously extremes. I will show you with the primo. For example, here you see they are both showing extreme in this zone. In this zone, they are both showing extremes also. At the same time, if we go to the left of the chart, you see here you have a conjunction of a convergence of the extreme of the two obus. Here you have a convergence of the extreme, the tops of the two obus. So keep that in mind. That is very important for the primo in a few minutes. So, but you can also use these two obus as previously you used the STO RSI and the obus 13. So whenever the two obus crosses, for example, here, you have across the green obus cross down the yellow obus, you have a sign here for a possible MX in your price, because this indicates a top in the price, and the price may reverse or may retrace. Conversely, when you have the green obus crossing up, like here, the yellow obus, you are at the proximity of a bottom. And if you were in the right conditions, so you can make, it is not the case here, but you can take an MX here to close 1 unit. Okay? Well, you can also exploit in the green obus, in the 5 period obus, all the same sign you have on the 13 obus or the story RSI. That is to say, all the M's, all the W. You see, you have a W, the price is making a bottom here and it goes up. You have an M, a triple M here also, even, and the price is going reverse back and make a retracement, a down retracement. You have here M, and again the price is making a retracement downwards, and so on. And of course, also, we have seen that the divergence in the story RSI or in the obus 13 are very important if we are already far in the trends, but of course, with the obus 5, the divergence are also important. So, if the story RSI and the obus 13 do not give these exit signs, if the obus sign, on the contrary, give that sign, so take it into account to take a profit with an MX or with an XXX eventually. Okay? So now let's go back to the waves and combined with the tiger tunnels. I have prepared a chart for that. I think it is this one. Yes. Do you remember this chart when I explained the concept of the waves? What I have added on that chart is simply the tiger tunnels. You see here the 2 greens, the brown, the yellow, the pink tiger tunnels. And if we scroll down through the chart from the beginning, let's put the home button. What do we see? We see that here you have the bottom of the secondary wave. And this bottom happens somewhere between 2 tiger tunnels here.
Hello, you
Let's count them. 1, 2, 3, 4, 5, 6. The 5th and the 6th tiger tunnel. Yes, Chris.
Sorry, it took a while for the chart to catch up again. So.
Okay.
Just a reminder. Okay.
Do you see the chart now?
Yes. Yes.
Okay. So you see here you have a secondary wave here, and you have the bottom of this wave here between the 5th and the 6th tiger tunnel. Okay? Let's take the next wave, secondary wave, in the downtrend. Here you have this secondary wave. And the bottom of this wave is right on the tiger tunnel, on the 4th tiger tunnel. On the next secondary wave, you have also the bottom of this wave, also on the 4th, right on the 4th tiger tunnel. Now let's take some example with an uptrend. So you have here a long secondary wave, and you have the top of the secondary wave here, on which tiger tunnel? Right on the 3rd tiger tunnels. And sometimes you may have important retracement, like here, also from the 3rd tiger tunnels. Here, another important retracement from also the 3rd tiger tunnel. Here also, and so on. Let's scroll down the chart. Sometimes, of course, you may have small waves where the bottoms or the tops are not far in the tiger tunnels. For example, here you have a bottom on the 2nd tiger tunnel. Here on the 2nd tiger tunnel. Here in the uptrend, also right on the 2nd tiger tunnel. Sometimes just on the 1st tiger tunnel. And then when we have good movement, nice movement. You see here a long wave, secondary wave. You have the top of this wave right on the third tiger tunnels. Here in the downtrend, you have a long secondary wave here, and you have the bottom right on the third tiger tunnels, with an important retracement here, also starting from the third tiger tunnels. So right on the tiger tunnels, or sometimes between two tiger tunnels, just in the middle point between the two tiger tunnels. You can scroll down as far as you can in the past. You can scroll down as many charts as you want, as many pairs as you want. What you will see quite always for normal or high volatile pair, that the reversal or the important retracement will quite always happen at the third or fourth tiger tunnels. Sometimes, but more rarely at the level of the fifth or sixth tiger tunnels. Okay? And this is important. This will be the cornerstone of our reversal trade. Okay? Let's take another example. You see here, even with a very long secondary wave, the retracement, the reversal, starts at the level of the third tiger tunnels. It is rare to go on higher tiger tunnels because these tiger tunnels adjust themselves based on the home base moving average. Okay? Let's see here. Let's wait a few seconds for the chart to refresh. So here you see a nice secondary wave, and you see two nice retracements here right on the fourth or the third tiger tunnels. So the third tiger tunnels will be a very important line for our reversal, but there are also other conditions to take the reversal. And now I'm going to explain the details of the reversals. Let's go back to our original pound-yen chart. And let's take some example on this chart. So here an example. Well, you see here that after an uptrend, you have a very strong uptrend. The price is doing a steep angle. The price is not really parallel to the Mo line. This shows that the price will soon revert. Whenever the price makes a steep angle, you may forecast that soon or later it will revert back. It will make at least a retracement. So here the price reached the third tiger tunnels, 1, 2, 3. I don't count the gray here at the first tiger tunnels, but I display it for other reason. So the first green here is the first tiger tunnel. So we have 1, 2, 3 tiger tunnels. When you see that, let's show with an arrow here, you see several phenomena happening. First of all, you see that the price is making crabgrass outside the Bollinger Bands. You see the price is at the level of the third tiger tunnels. You see also a nice convergence of the price, the Bollinger Bands, and the tiger tunnels. These are all conditions which must ideally be filled for a primo. And then, when the price has made its tops, let's show the top here. You see that, incidentally, it is a pin bar. Very often, a tops or a bottom will end with a pin bar. Not 100% of the time, but very often. But what do you see on the indicators? Oops. Why cannot I cannot? Oh, okay. What do you see on the other indicator? You see that around the top here, the accelerator is making a maximum here. The obos is making a maximum, the yellow obos is making a maximum at the extreme of its scale value. The green obos is making also a maximum at the extreme of its scale value. And it shows already here a divergence. and it has crossed down the yellow obus. Here also, the Vinini is at the extreme of its scale values. You see? Sometimes it will show also a divergence. And here the Stoer RSI is also quite at the extreme of its scale value. So this is the meaning of a possible primo, an extreme. The price is at an extreme, and all the indicators, or a majority of them, show also an extreme. In this case, you can make a primo, and the entry of the primo is when the price goes back inside the Bollinger Band and closes below, here because we are in an uptrend, closes below the non-line moving average. So this bar here, is the setup bar. You see that it closes inside the Bollinger Bands. It closes below the non-line moving average, which is itself flattening, and so your entry bar will be the next bar, and you can make your entry immediately there, for example, on the open of the next bar. And you will place a tight stop loss, which will be just a few pips above the high, the previous swing high here. And so you will have here a stop loss of about, you see, 26, 27 pips. Sometimes much less, sometimes a little more. And the rule for exiting this trade, we will call primo, because it is not a mo, it is a primo. It comes before a mo, primo. The rule to exit this trade is at the first sign of weakness, at the first sign of danger, because the trend may always resume at any moment. Here, where is the first sign of weakness? You see here that the price bounces off the blue balance line, and it retraces up, and the non-line moving average is flattening, and the price goes above the non-line moving average. So you have here the place to exit your trade here. Okay? And we will note that exit P666 for primo exit. The sign of weakness may happen everywhere during the movement of the price. It may happen just a few pips after you have opened your trade, or it may come very, very late. For example, let's take another example here. The price touches the Tiger Tunnels, the third Tiger Tunnels, for the, how many times since the trend starts here? For the second time. You have also all the conditions for a primo. You have the price, the Bollinger Bands, and the Tiger Tunnels, which are converging. You have the price, which here the price does not poke out the Bollinger Bands, but it stays out inside the Bollinger Bands. You have all your indicators here, which are at extreme. You see, not exactly at extreme for the Vinini, but extreme for the Stoer RSI. So you have a majority of indicators which are at their extreme. So when the price crosses down the non-line moving average here, you have your entry point. So this is the setup bar, and you have your entry point here. And where do you see a sign of weakness? Here, when the price bounce off again, but it is a coincidence here, the blue balance line, and you see the non-line moving average flattening, you have, and even changing color if you were too late, you know that here you must make an exit of this trade. And you bank a profit of 20 pips minus the spread, which is 6 pips here, 14 pips twice. And on the first trade here, you made 29 pips minus 6, 23 pips twice. Okay? And here you can re-enter the primo, because you see also another phenomenon. You see that here you had resistance lines from the swing high here. The price failed to reach and to cross this support line. So this is a resistance line. So this is a very, very important sign of weakness for the trend. So in this case, you can re-enter the primo. Okay? Well, let's see other example. Here, for example, you have the trend, the downtrend here, which ends here on a long bar, with a bottom such that all the indicators, or quite all the indicators, are at their extremes. You see the obos, the yellow obos, which is pointing down, not yet at the bottom, but this is only here on the bottom of the price. But it is not here. It is not the entry price for the primo. The acceleration here, acceleration indicator, is quite at its bottom also, and the stochastic RSI is quite at its extreme also. And then you have a nice convergence of the price, the Tiger Tunnel, the Bollinger Bands. The price then at a moment goes back inside the Bollinger Bands and cross up and close above the non-line moving average, and so you have on the next bar you have your entry point. You cannot enter, of course, as usual, if your setup bar here is a long bar. And so you let the price goes up and you exit at the first sign of weakness, which is here when the non-lag flattens and is ready to change color, and so you exit, for example, here. Okay? And on this movement, you made 31 pips minus 6, 25, twice 50 pips. I have indicated that the weakness sign is when the non-line moving average is flattening. It will not always be the case. Let's show some example. Here, for example, you have the price bouncing off the third Tiger tunnels. You can make a primo eventually, so somewhere here. And here, you see that the price meet a resistance formed by the second Tiger tunnels and reverse back to the downside. So here you have a very strong sign of weakness. So if you are a little Freddy Cat or if you are very risk averse, you can exit here and don't wait for the non-line moving average to flatten. But if you have the courage to stay in the trade, you can wait for the non-line moving average to flatten. You see here, sometimes, this is not a good situation to make a primo, because you have the price here is riding the Tiger tunnels, and when the price is making a large bottom like that, it's not very a good situation to make a primo. The best primo is when the price is making a rather steep angle, not too steep, but a rather steep angle, a clear movement. Because what may happen if you have a too steep angle, you will have a first retracement, a first contrary retracement, and then the trend resume, and then after you have the correct reversal. Well, you see here a typical example, even if the angle of the price is a little too steep for me, but the price bounce off the third Tiger tunnels, cross up the non-line moving average inside the Bollinger Bands, and so you can enter your primo there, and you ride the movement until the price show a sign of weakness here, with the non-line moving average flattening and with this intermediary Tiger tunnels being rejected. What you may see sometimes is the price. For example, here you have a little sideways with several reversals bar. You can consider that this is a weakness, and you can also, it's not incorrect, you can also exit here. Okay? But if you have the courage to stay because the non-line moving is still green, you can exit later. Here, this is not a good situation because the price has not reached the third Tiger tunnel. Here on the uptrend, on the other side of the trend, in an uptrend here, you see that the price has quite reached the third tiger tunnel. You could consider to take the primo, and you have an example where the price or the trade does not give many pips. If you exit, for example, here, because you see that the tiger tunnels here is rejected by this red and blue bar, so you will just take a few pips, 11 pips minus 6 for the spread, 5 pips. Sometimes you will just break even or exit with a very small loss, but the counterparty is that your stop loss will be very tight. Let's take another example here. You have a nice movement right to the third tiger tunnel. You have at crabgrass here, a nice convergence of the price, the tiger tunnel, the Bollinger Bands, and the price going back inside the tiger tunnels and closing below the non-line moving average. So you have your entry level here. You would have placed your stop loss here, and this would have been a losing trade. You would have lost a few pips, 26 pips, 22 pips, 23 twice. But after that, you see that you have another bottoms here. You are again in the conditions to make a primo with your setup bar here, your entry price here, and you exit at the first sign of weakness somewhere here, and you make here some pips, 20 pips, minus 6, 40 pips twice. Okay? And you see that at the moment where the price filled the first time the condition, you have all the sign of extremes here are on all the tumblers. The two obos, the acceleration, the Vinini, the Story-RSI. Here, this is an example where the price doesn't stop on tiger tunnels, but between two tiger tunnels. The price pokes outside the Bollinger Bands, making a crabgrass. Then it reverses back inside the Bollinger Bands and crosses up and close above the non-lag moving average. And so you can enter here and you ride all the up movement until the first sign of weakness, which is here. And you can exit here with a profit of how many pips? 2 times 93 pips minus 6 pips, so 87 pips twice. Okay, but you will have a stop loss here just below, a few pips below the bottom here. Stop loss of 51 pips. So you have a reward ratio of quite 2 to 1. You will have often for this kind of trades a reward ratio, a risk reward ratio of, or a reward risk ratio of 2 or 3 to 1. So this is why they are very interesting to be taken, to be tried. Let's take another example. Here, for example, you have the tiger tunnels, the third tiger tunnel, which is reached here or here. So you can make a first attempt here. You exit here. You must react very quickly to take your profit on the retracement here, because you have had a very nice pullback here on the Mo line. And so you exit, because what will happen on the retracement here is that you will have a situation to make a remo or a scaling in the down movement, and this will be important to analyze correctly and to understand correctly. So this means also this is a very important conditions you have also to fill. If you are in a trend, if you are making a max trade in a trend, for example here, you have probably made a remo somewhere here, let's say here. Let's check if this is not a squeeze, to be sure. We have 43, 45 pips, but it's not really a squeeze, so your remo here is nice. So here you make an MX, you take a profit, then you make scaling. For example, here or there, you make a scaling. Then you make another scale-in eventually here. And then here you are in a situation to eventually take a profit because you have a divergence here on the green obus or on the stochastic, but because the three EMA are well pointing down, are regular, you can decide to stay in the trend, and so you make only an MX, and then you realize that you have the condition filled for a primo. Then in this case, if you are in the conditions for a possible primo, instead of making a MX here, you must make a XXX. Because in fact, the primo may be a reversal. So you reverse all your position. So you make the XXX, then you take the primo. And when you close the primo, if you are in the conditions to resume the trend, you make a remo or a re-entry. Okay? For example, here you have made a re-entry. Let's note the re-entry RE to not confound it with a true remo, which is when the price crosses the Mo line. So you make a re-entry. Here you have a situation eventually where you can take a profit. You also see a divergence. You see here. So you could consider to make another XXX here. But you see you are again in the conditions for a primo here. So here at the bottom you must make an XXX. Never have a trade in both directions. Don't have an up trade with a down trade. So you make a XXX and you revert your position here by the primo, and so you close your primo here at the first sign of weakness in the retracement movement. Okay? Well, there will be sometimes situations where your primo will give you very huge profits. Let's try to find an example. These last times, this kind of situation were very rare. It's not easy to find one, but I will try to explain you the concept. Or let's take another pair, for example, the euro-yen. No, I don't think I will find an example. But I will explain you the concept here on this situation. Let's suppose that here it is not the case, but let's suppose that the price has reached at least the third or the fourth tiger tunnel. So you would have your primo somewhere here, okay? And let's note it primo. It's not the case. All the conditions are not filled, but just pretend that, just for the concept. And suppose that the non-line moving average stay green until the home base. Okay? Sometimes what will happen is that the price will continue upward here and cross the home base and give an uptrend. So in this case, when the price crosses the home base, somewhere here, even if the three EMAs are not in the right order, you can make an additional entry. Let's call it a scaling. And then you will continue to ride the trend as you already know, because now you will be in an uptrend. You can make a scaling or eventually a Mo, but it's not really a Mo. Because, I repeat, this kind of Mo will be very risky because you don't have the three EMA in the right order, but you can do it because when you are at this level of price, you have already all this movement, which produce a nice profit. Let's measure how many pips. For example, let's suppose here, from there, the primo until the home base, this is a movement of 73 pips, twice. You have 73 pips under your hand of profits. So if you have the price crossing up the home base, you can take a Mo even if the three EMA are not in the right order. Okay? I would like to show you an example, but I have not found
Eusebio.
a good one. Yes, Chris?
If you go to the the end of the chart, to now, there
To
could be
the
one,
end of the chart?
yes, to the right end. Yeah, it
To
could
the
be
right
one
end.
setting up now.
Yeah. Oh, yeah, no, it's not a good example because we are not at the third or fourth Tiger tunnel. But let's pretend this green Tiger tunnel is the third Tiger tunnel. You have the example here. Indeed, you have the price making quite a BT move, a breakthrough move. You see that when the price crosses the home base, let's count the bar 1, 2, 3, 4, 5 for the blue. Let's draw a vertical line. 1, 2, 3, 4, 5. The blue moving average is here. Okay. The green, the red is 2 bar later is here, and the yellow, it has a shift of 3. 1, 2, 3. It's just here. You see that the 3 moving average are not yet in the right order, but the price has crossed them. They are well separated, and it has crossed the home base. So here, when the price crosses the home base, in this case, you can make a mo. And you can call that a mo. It has not a special name. Because here you have enter a primo, and this primo gives you a nice profit. So this nice profit allows you to take a risk here. This trade is a risky trade if it was taken alone, but with this profit you can take this risk. Okay? Yes, you do not count the gray Tiger tunnels. The gray Tiger tunnels which will count only for non-volatile pair. If you take a pair like the euro-pound, for example, or the OC-US dollar, for example, most often the reversal will happen at the second green Tiger tunnels. So to keep the standardization of 3 Tiger tunnels, you can draw the gray Tiger tunnel, and so you count it as the first, and so the second green will be the third, in fact. Okay? Well, and when this situation happens, you make much more profit on your max trade, on your more trade, and you ride the rest of the movement as you have already learned. So whenever you have a scale-in with the MACD, you make a scale-in. Whenever you have the possibility to take an MX profit, you take a profit. And when you have the sign for an exit, you make your XXX and eventually later your REMO. Okay? When you have experience with the Primo, it is also possible, I do not advise you to do it immediately, it is also possible when you have taken a Primo here, and let's note it Primo, when you see the price crossing the 3 EMA, if they are well separated but not in the right order, often you will have the more line, then the blue line, then the red line. And if you have placed enough between the last moving average, which will often be the red line, and the home base, it is not the case here, but if you have enough place, you can make a scaling when the price crosses the red line, because you have here the price crossing the 3 EMA. And less you will have bars, better it is. If you have 1, 2, or 3 bars, it is still better. But what is important here to make the scaling is to have enough place, 30, 40 or more pips between the red line and the more line and the home base line. Never take a scaling here if you are too close to the home base. Because the danger here is the price will not cross the home base, but it can bounce off the home base and the trends resume. Okay? Well, let's see if there are other important things with the Primo. No, I think I have said all that I had to say. We will see at the next session another indicator which will allow also to visualize extremes in the price, in the tops or bottoms of the price. You see here, you have a nice convergence of the price, the Bollinger Bands and the Tiger Tunnels. It is not the case here. You have not that nice convergence. So the price then bounces off, goes back inside the Bollinger Bands, goes above the non-line moving average, and so you can make your primo. And at the first sign of danger, which may be here when the price bounces off the Mo line, or if you have the courage to stay because the non-lag is well pointing up and stay green, you can exit here, there, or there, okay, when the non-lag begins to flatten, okay? And let's check indeed the Vinini here. Let's draw a vertical line at the bottom of the movement. What do we see? We see that the Vinini is making a bottom itself at the extreme of its scale value, really at the extreme. So this is a good situation. You don't have an extreme on all indicators. For example, you have, I don't have the story SI here. Let's draw it is here. Let's put the template, the right template. It is this one. Let's draw again our vertical line. So you see you have an extreme in the two obos. You have a bottom, not exactly an extreme in the Soraza, but you have an extreme in the Vinini. So you have a majority of indicators showing an extreme. So this can be taken as a possible primo. Okay, in this case, you don't have the convergence between the Bollinger Bands, the price, and the Tiger Tunnels, so don't try to take this primo. Okay? And an important point also, you see that here the price comes very near the Tiger Tunnels. One time, 2 times, 3 times, 4 times. The best place to take the primo is when the price has touched 2 or 3 or more times the Tiger Tunnels. On the first time the price touches the Tiger Tunnels, you will have less chance to have a successful trade with the primo. Okay. So this is also a clue to take the primo. You see here, it's not the first time the price touches the Tiger Tunnel. You have the convergence between the price, the Bollinger Bands, the Tiger Tunnel, and you have the price going back inside the Bollinger Bands and crossing over above the non-line moving average, so you can make your entry somewhere there, and you ride the price until you see a sign of weakness, for example here, because you see before the non-line moving average flattens, you have a rejection here of the green Tiger Tunnel here. Okay?
Eusebio.
Well, yes.
Sorry.
Yes, Chris.
Just to be a bit more specific about the convergence piece, do you
Yes.
mean that the Bollinger Band itself comes very close or touches the Tiger Tunnel line itself?
Yes, indeed. We must, as I am used to say, we must be rigorous, but we must not be rigorist. If the Bollinger Bands come close the Tiger Tunnels, it's right also, it's good also. Here you are not close the Tiger Tunnel. Let's take another example. Here you are right on it, here you are right on it.
I'm sorry, with the chart moving, I don't know where you're pointing. Could you highlight it?
Yes, but I'm moving the chart, but I will stop the chart very soon.
Okay.
For example, here. So do you see here this situation?
Yes. Thank you.
You see that the price touches the Tiger Tunnels, but the Bollinger Bands is not on the Tiger Tunnels. It was on the Tiger Tunnels a few bars before, but here the Bollinger Band, the upper Bollinger Bands, is close to the Tiger Tunnel. So this is the right situation. This is a good situation. And so when the price closes below the non-line moving average, you have your entry point. Okay? And your stop loss will be a few pips above the previous swing high. And so you ride the price as long as the moving average stayed red, and you exit at the first sign of weakness, which will be here, giving you somewhere here, giving you, in this case, a small profit of perhaps 4 pips, even a small loss with the spread. You see?
Okay, thank you.
Well, okay. Here, in all the example we have seen only situation with the third tiger tunnels, but if this happens on the fourth or the fifth tiger tunnel, it's still better. Most of your primo will be on the third and fourth tiger tunnels, because the price will go rarely on very higher. It may happen, but it will be more and more rare. I think the fifth tiger tunnel is reached approximately between 5 and 10% of the case. So, well, do you have questions about the primo? Are primo most likely to happen when secondary waves are completing? Yes, the primo happens when the best primo happens at the very top or bottom of a secondary wave, indeed. But not always. They may happen for important retracement of secondary waves, but not the end of the secondary wave. Okay? What about Vanini angle? Nicolas, I don't really understand your question. What do you mean by what about Vanini angle? Does the BB have to be on the tiger tunnel for a primo? I have said you must have a good convergence between the price, the TT, and the BB. And the convergence means that the three meet quite at the same place. Like here. You see? Meet between two TT also valid for primo instead of close of to the TT regarding the price. Yes, if you are above the third tiger tunnels, not between the second and the third, but between the third and the fourth tiger tunnel, for example, it is also a right place to try a primo. Well, so your homework for the next session, which will be Saturday at 5 p.m. East. So you have to make 3 homeworks. 2 charts in one email, please. Don't send your charts separately. This multiplies unnecessarily the email. So 2 charts in one email, 1 long chart and 1 short chart. You will mark on this chart only the MO, for example, a BOMO or a BTMO or a SafeMO or a REMO, and the primo, and of course the exit of the primo. For a primo, we will note them like here, primo, and for the exit, you will note them P XXX. Okay? So the MO, you will note them as usual. For example, here, BOMO, breakout MO. And I want also you mark the XXX where you make the XXX of your MO. For example, you have a divergence here on the story RSI, you have a divergence on the OBOS, you will make your XXX here. Okay? And then your primo. And you note also, you mark also the stop loss for the primo. If you want, but it's not necessary, you can also mark on the chart all the scale-ins and the MX, but it's not mandatory if you want. Only the MO, the XXX, the primo, and the PXXX, just to show that you have understood the concept of the primo. Okay? So 2 charts in one email, and then you will try to make 1 demo trade as you have done for this session. one demo trade, you can choose any pair you want, the GBP yen, the euro yen, the pound dollar, the euro dollar, any pair you want. Take the 5 minutes time frame, and you try to make all the kind of trade you already know. So an initial MO, BO, BT, SAFE, MO, all the scale-ins, the MX when it is necessary, the XXX, and if you are in the conditions to make a primo, make the primo. Okay? So 2 charts in the past and 1 chart demo trading. Okay, that's okay. And the homeworks are due for Friday, 6 p.m. East. I will have some difficulties to grade them after that time, after 6 p.m. East. Okay? So now we can finish the session, if you want, by, first of all, some do's and don'ts. I have updated the PowerPoint here. So you see that I have added a line in the do's column. Trade only the perfect primos. Only take the primos if all the conditions I have presented are filled. And never forget, get out of the primo at the first sign of weakness. Okay? So this is very important, this point. Normally, if you take the perfect primo, you should have a winning rate of approximately 80–90%. Okay? Yes, 3 homework, Phil. 2 pass chart, 1 long, 1 short, where you mark all the MO and all the primo with their corresponding XXX, and one demo trade. So, to finish the session, I will give you some other comfort indicator. Let's clean up this chart, first of all, by reapplying the template. Okay. And I'm going to add one indicator. You have already, if you remember here, an indicator with white arrows showing when the price crosses the home base. Okay? We have another indicator, which is max 21, I hope, yes, I have 21,233. First of all, let's remove this one. And take the 21-23 crossover. Do not change the parameter, which are 321, 3233, and you have also an alarm on that indicator, and you can change the color of the arrows, for example, yellow and aqua colors. And here, what you will get, whenever, let's see here, whenever the price crosses the home base, like previously, you have an aqua arrow, which will be pointing up if the price crosses up the home base, or down if the price crosses down the home base. And you have also yellow arrow, like here, yellow arrow, whenever the price crosses up or down, this time the MO line. And the sound alarm you have, it's when the price crosses the MO line. So I suggest you to not activate the alarm on many pairs at the same time, because you see that there are times when the price crosses up down the MO line, you will have a lot of bing, 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 and you can become crazy. So I do not advise you to switch on too many alarms. Okay? And we can also, so this may be very useful to be alerted if you are not able to stay always behind your screen. At least you can have a sound alert to alert you when a potential situation may happen. And we have also another indicator. I don't use that indicator, but I know some Maxer use it. It is called the shining star offset with these parameters 13, 0, 0, 13, 1, 0, 0. Don't change the parameters. You can change the colors, green or lime or red. You will see, or you can, for example, use white if you want. And you will see what this indicator will give. You can use double whites. And you will have a star here. This is why it is called a shining star. Whenever the price make a swing high or quite always a swing high or low. This may be helpful to identify your your previous swing high or low when you have to consider them to put your stop loss. Okay? Be aware of this indicator. It may somewhat repeat a little, not too much, but it may somewhat repeat. And during a bar is built, before it closes, the star may disappear. Okay, it is fixed when the bar closes. Okay. Well, so this was the program for today. Now we still have perhaps a few minutes for question and answer. Chris or Jerry, are there some questions I have not answered during my presentation?
Eusebio, I don't have any. I haven't noted any. I think the only question that I perceive might come up is on a primo. Yes. Someone will probably ask, do you scale in? Do you do any scale-ins on a primo, or do you go from a primo directly to an XXX? That's the only thing that I anticipate being asked.
Okay. The only place where we can scale in without too much danger is when the price crosses the 3 EMA, like in this example. This is not a good example, because this is probably a news. When the price crosses the 3 EMA, even if they are not in the right order, but if there is enough place, 30, 40 pips or more, between the red line and the home base, you can scale in here. If you were in a primo, you can scale in. Okay? And then if the price crosses the home base, then you can also scale in when the price crosses the home base. Let's try to find an example. It's not easy to find an example these days. Here, for example, you have a situation. It is sufficient to say it is difficult to find one example to have just immediately one example here. So here you have a convergence of the price, the Bollinger Bands and the Tiger Tunnel. So you have an extreme here on all the indicator. You have a first entry here, which may fail if you have a too tight stop loss, but immediately after you can make a second entry here, okay, somewhere there. So you have your primo here. Let's note it, primo. And let's suppose the non-line moving average here is always green. What you can do eventually for the non-line moving average, you remember its parameter is 13. You can use also 21. You will have a smoother non-line moving average. And in this case, even if you have a small portion of the non-lag here, which is red, but in real time you will have no time to react on just a few moments it is red. So you have an example of the situation here when the price crosses up the home base. And so here you have the situation I just explained. You have the price which crosses up the 3 EMA, which are well separated. We are far enough the home base. We are, for example, at how many pips? At 50 pips. So here you can take the risk to make a scaling. You can call that a primo scaling. There is not standard denomination for this kind of scaling, but I propose to use primo scaling. And if you have on that scaling all the indicators which are favorable. You see, for example, the Stoerzi is pointing up, the Vinini is pointing up, and above its yellow line. The green Obos is pointing up. The yellow Obos is at the extreme, showing a nice uptrend. You have just the accelerator, which is not really favorable, but it is still positive. So you have a majority of tumblers which are positive, so favorable. So you can scale in here. And then later, when the price crosses the home base here, you can again scale in here. Okay? Because here, now you are in a situation of perhaps quite a BTMO. Let's check if we have really a BTMO. 1, 2, 3, 4, 5, or the BTMO will be here. So there you can scale in, hoping the trend will continue, of course. Now, during that movement, if you feel that at a moment you have a sign of weakness like here, the price is making a consolidation, you have the Primo, you have scaling, you can make an MX. For example here, which we call a PMX, Primo MX. Okay? And you reduce your risk. And if you feel it is a strong weakness, you make also an XXX instead of a MX. Okay?
That was a good explanation. That was a very good explanation. Thank you, Eusebio. And if you look over at the chat sheet, there's just a couple of questions that have come up while you were explaining this. One of them has to do with the price crossing the home baseline, just the center line, that is the primary 233 home base line, or crossing over and closing above one of the channel lines. That was asked by Stefan.
This is a very good question. This depends of your risk averse. Normally, the home base is the center line, and so it is sufficient for the price to cross and close over this center line. Now, if you want to be more conservative, you may also wait for the price crossing all the complex here of the center line and its two channels, the high and the low, the high and the low channel. So it's up to you to choose. Personally, you know, I am an aggressive trader. I like when the price just close above, in this case for an uptrend, above the medium line. But you can wait for all the complex to be crossed. Okay.
Okay, good, thank you. And then there's just one other comment that's made here, and I think some of us have responded to this in the chat. See, someone mentioned about because there are so many indicators, they find themselves hesitating too much. And if you could just respond to that, I think we had a discussion about, or similar to that this morning in the application room.
Yes, indeed. I will say first of all that there are some indicators you can eliminate. For example, the shining star you can eliminate. I don't use it. The two Obos you can just use one eventually. The Stoerzi, the MACD, when you will have practice, you will recognize instead of the MACD when you have a retracement, a pullback, or a ledge to scale in. You can eventually keep the diamonds, that's not a problem. And for the Stoerzi, you will also recognize that the price is making a bottom or a high by the configuration of the bar themselves. But this needs practice. So until you don't have enough practice, don't eliminate the indicator. But you must keep in mind that each indicator has a role. The MACD is used for the scaling. The Stoerzi and the Obos, they are both stochastic indicators. Both are used for exit. For the entry, they are just tumblers. The accelerator is just a tumbler. So eventually, if you don't feel comfortable with it, don't use it. Simply. The Vinini is just there to help you to identify the secondary waves. So each indicator has a specific role. And the difficulty of the MAC system is precisely because we have to take into account many details to be able to exploit, to milk as many pips as possible from each movement the price is doing during a wave. But with practice, you will be able to eliminate some of them. Normally, The max system, the basic max system, is what you have here in the upper zone. And with practice, just that will be sufficient. Okay?
Good answer. And I think one of the things we talked about this morning, too, that is if you choose to use some of the indicators, which we call tumblers, if we have a majority of those tumblers that line up, then it indicates a good situation for trading. It's a majority, not all of them, so we don't wind up overanalyzing or becoming paralyzed by analysis of indicators.
Yes, indeed. And later, if you work well at the end of the seminar, you will have an indicator which will show you this kind of situation. I can perhaps show you to encourage you to work well. I think I have it here. Wow.
Thank you. Thank you.
This is the dashboard. You have a square for each pair. You can attach such a square to each pair individually, or you can add as many pairs as you want here on one Windows. And so for each pair, I don't know if you see correctly. Let's take this one, the pound dollar. You have on each time frame from the 1 minute to the monthly time frame the situation of the 4 EMA, the 21, 55, 89, 233. A red status means that the EMA is pointing down. A green status, it is pointing up. And a white status, no, there is not white status for the EMA. It is, the EMA is up or down. And below, in the 3 line below here, you have the price, an indication of the price crossing the home base, an indication of the price crossing the Mo line, an indication of the Mo line crossing the home base. You have an indication of possible scale-ins given by the MACD, and you have here the number of favorable tumblers in each kind of movement, in up movement and in down movement. So if you are exploiting a downtrend, you will be interested in the number of tumblers, favorable tumblers in the down side here. You will see, for example, that in the 30-minute time frame, you have not yet a situation a tradable situation because the status are white, but if it was the case, you have 4 favorable tumblers. So 4 against 6, you have a majority of favorable tumblers. So this could be, or could give, a nice situation to analyze in detail to see if you have an opportunity to trade. And as you have that on all the time frames, you have at a glance, you have the situation of all the possible opportunities to exploit. You see, for example, here, for the USD yen on the 4-hour time frame, here in the weekly time frame, you have a possible scaling with 4 favorable tumblers. You see? And this at a glance allows you to see what is happening on the pair. And you can also arrange your pair. For example, you can put on the first line all the pairs which are positively correlated. When one is going up, the other are going up also. Below, you can put the negative correlated pairs. When on the first line they are going up, on the second line they are going down. And below, you can put, for example, the unrelated pairs which are not correlated with the other. So that you will have another view of what is happening on the world market. Okay? Well, okay, if there is no question, I propose to stop here. So I remind you 3 homeworks, 2 charts in one email, one a long, one a short, where you mark just the Mo's, their XXX, the pre-Mo's and their BXXX, and 1 demo trade where you will mark everything. Okay? For Friday, 6 p.m. East, last time. So I wish you a very good end of day. Make good trades and make good homeworks.